Finally, the moment has come that you decided to trade using trading bots. You bought an expert advisor that you saw on an Instagram page with a perfect equity curve and a high win rate with the promise of a set and forget profits. Soon enough, losses started showing up, confidence drops, and now you're wondering whether this expert advisor actually works. Here is the reality most beginners don't want to hear. When an automated trading system fails, it's usually not because the expert advisor is broken, but mostly it's how it's being used. Algorithmic trading attracts beginners because it looks like structure, discipline, and emotional control all rolled into one. But automation does not remove responsibility from trading. It magnifies it. And when that responsibility is misunderstood, losses accelerate instead of disappearing. In this video, I will show you why treating an expert advisor like a hands-off money machine quietly destroys accounts, how running a strategy you don't understand hides risk until it's too late, and why backtests and risk settings mislead most beginners before live trading even begins. Before we get into the mistakes, there is something fundamental you need to understand about automation. Algorithmic systems or trading bots were never designed to replace judgment. They were built to execute decisions precisely once those decisions were already made. Humans defines when the system could operate, when it should stop, and how much damage it is allowed to do if conditions changed. What had changed over time is how these tools are marketed. Execution engines started being sold as decision makers, and that's where most beginners lose control. You can see the exact same pattern happening right now with AI, where people use it full on without vetting, structure, or boundaries, expecting it to think for them. When it fails, the tools get blamed instead of the process. Expert advisors fall into the same trap. They don't understand context, they do not judge conditions, and they do not know when not to act. They simply execute the rules they're given, regardless of whether these rules still make sense. Before we get into the mistakes, if you're serious about using automation in trading properly, not gambling with it, tap the like button. It helps this kind of content reach traders who care about structure and rules, and it could genuinely save a lot of people from blowing their accounts. You buy an expert advisor, jump straight into the set files, and start searching for the perfect preset. Telegram groups, Discord servers, and comment sections are full of traders sharing settings and strategies that supposedly pass prop firms or double accounts. You load the set files, enable the expert advisor, and step away. That obsession with ready-made configurations signals one thing very clearly: responsibility has been outsourced. A set file is nothing more than a snapshot that worked under specific conditions, such as broker behaviors, volatility regimes, spreads, sessions, and risk tolerance. Markets don't stay static. Volatility changes, spreads widen during news, liquidity thins at rollovers, and session behaviors shifts throughout the day. The expert advisor does not recognize any of this and continues executing rules as if nothing changed. This becomes especially dangerous around high-impact events like CPI, NFP, and central bank announcements, where execution quality degrades and price can move faster than the strategy was designed to handle. In prop firms' environment, one volatile session is often enough to erase weeks of disciplined trading. Successful algo traders do not rely on presets to think for them. They supervise conditions, define clear rules for when the expert advisor is allowed to trade, and pause execution when environment no longer fits the logic. This mistake usually follows immediately after the set file obsession. Ask most beginners how their expert advisor actually trades, and you'll hear surface level descriptions like win rate or drawdown, but very little about how risk behaves under stress. For example, every expert advisor follows a specific structural logic, and each structure fails in predictable ways. Trend following systems, for instance, struggles in range-bound markets. Scalpers depends on tight spreads and clean execution. Grid systems accumulate exposure as price moves against them. And martingale logic increases position sizes after losses, concentrating risk when conditions deteriorate. None of these approaches are inherently wrong, but running them without understanding how losses are handled and how exposure scales create invisible risk. Many traders are drawn to strategies that look smooth for a long period of time, with frequent small gains and modest drawdowns, without realizing that tail risk only reveals itself during sustained moves. When that move arrives, margin usage increases rapidly, and a normal market continuation produces disproportionate damage. In prop firms' accounts, for instance, this misunderstanding is magnified because drawdown rules are enforced regardless of long-term expectancy. If you cannot clearly explain how entries trigger, how losses are managed, whether exposure scales, and which conditions stress the strategy most, you're not managing a system, you're hoping it behaves. Backtests convince traders emotionally long before they convince them logically. Clean equity curves create a sense of certainty that does not exist in live markets. The issue is not using backtests, but treating them as a proof rather than approximation. Most traders' backtests assume fixed spreads, for instance, ideal execution with no slippage, instant fills, which quietly remove the hardest part of real trading. Over-optimization then tunes parameters so precisely to historical data that the system becomes fragile and curve-fitted, even though it looks strong. These strategies perform exceptionally well in the exact environment they were traded on, but struggle when the market behavior shifts. The mismatch becomes obvious when traders move from testing to live trading, with variable spreads, execution delays, and real volatility. From prop firm traders, underestimated drawdown quickly turns into rule violations. Backtests should be used to explore stress and behavior across conditions, not to chase flawless performance. Robust systems usually look imperfect in testing because imperfection reflects reality. Automation does not reduce risk, it accelerates it. Because expert advisors execute faster and more consistently than humans, any miscalculation in risk is expressed more aggressively. Many traders rely on default settings or increase lot size when in drawdown, without understanding how the drawdown actually scales under pressure. Risk is rarely linear in outcome, even when it looks linear in input. For instance, doubling exposure does not simply double potential loss during stress conditions. Recovery logic with doubling the lot size without hard limit creates deferred risk rather than controlled one, leaving the account exposed to theoretically unlimited downside or blowing the entire account. In prop firms environments, this mistake is unforgiven. One oversized position or volatile release can invalidate an evaluation instantly or even the funded account. Effective expert advisor traders act as risk managers first. Maximum risk per trade, daily loss caps, and total drawdown limits are defined before the expert advisor is even allowed to trade. These limits override the strategy logic when necessary and are treated as non-negotiable boundaries. Most traders arrive in the algo trading world with expectations shaped by marketing rather than experience. Smooth equity curves and high win rate condition them to expect consistency without any interruption. When normal drawdowns appear, impatience follows. Settings are adjusted prematurely, risk is increased to recover faster, and systems are abandoned before probabilities can play out. Marketing reinforces this cycle by selling smooth performance instead of resilience and by masking tail risk. A simple economic question cuts through the noise. If a system could reliably compound capital with very low risk, it would not be sold cheaply to the public, right? Sustainable automation requires realistic expectations, respect for time horizons, and acceptance of variability within defined limits. Traders who align expectations with statistical reality are far less likely to sabotage their trading career. To help you start the right way, I'm giving you 3 things completely free of charge. First, the Easy Trend Expert Advisor, a clean and simple rule-based trend following system. Second, the Smart Traders Blueprint. It's the exact framework I use to evaluate any expert advisor before it ever touches real capital. And third, access to an AI GPT assistant designed to help you navigate automated trading systems step by step using the Easy Trend as the reference point, so you're not figuring things out alone. I left a link in the description to access all, completely free of charge. See you next week.